Welcome to Subramani. All of us are wondering as to how to react with regard to our portfolios because of the Ukraine-Russia war or the Russian-Ukraine war. Let's look at some of the things. Russia is a big player in the gas and oil market, especially in Europe. 16 to 22% is what it controls, and there is no way how Europe is going to give up using that energy. It is not that overnight. Look at somebody like Germany. Germany needs the Russian gas, it needs the Chinese market, it needs American banks, own banks, etc. I don't think they are going to give that up in a hurry. So Europe is also not interested in the conflict. It is just a poorly managed conflict with United Nations to take some more active participation or do something like that, but we don't know. We're not getting into that. So definitely energy prices will be on the way up. It will fluctuate, but I don't think we should use COVID situation and war situations to use the number and start extrapolating and saying, oh, the oil crude will reach $200 a barrel, or nor to say it will come to $40 a barrel. So yes, energy prices will fluctuate till there is certainty regarding the Russian withdrawal or Russian attack or whatever is going to happen. We will know it over the next few days, maybe maximum a week. We will know what is going to happen here. You have to also see what America is going to do about energy, about shale oil, right? All these things are going to impact the fuel prices or the energy prices. The energy prices, you've already seen what it has happened in India. You've seen GAIL going up, you've seen Coal India going up, right? The implications are when one fuel goes up, the other fuel will be substituted. So therefore, when one fuel goes up, other fuel also goes up. So Coal India is up, GAIL is up, and this is bound to happen. The oil companies could take a hit. Government also could reduce excise duty. So that could be the other impact, so that the price rise may not be too high. Given that the elections are in 2024, I don't think too many hard decisions will come. So this is the implication for the market. The way you have to look at it is to say, all those industries which have a very high energy content or coal content in their end product, like say cement, those are things which one has to look at and say, those are the ones which one has to look at and say, well, what will happen to those industries? Should you be buying cement just because the prices have gone down? Or should you just stay put and do nothing with your portfolio? Difficult questions to answer, but one thing is certain: don't be in a hurry either way. Selling off your portfolio because there is war did not make sense last week, nor buying too much of, say, cement because prices have fallen, so therefore we should be buying that. Well, that also may not make too much sense, right? So these are the two implications. So sitting tight over long periods of time makes sense. Also understand, I'm going to share something with you, what Ritol says. Just give me. I found a very useful note by Barry Ritholtz, an American, and he has said that he did some research. Whenever the markets went down due to war-like situation, he did some research and he's come to some very nice conclusions. I'll share the link because it has a chart and a graph, so I can't show it to you here. So I'll give you the link. And he says he started off wondering what is to be worried about. Should you be celebrating the end of the pandemic in the sense that the markets were opening up, etc., or should you be worried about a war in Europe? And well, the US market definitely opened 3% gap down. And there was some partial recovery, of course, but yes, it did open gap down. And he says, he has some very interesting observations. You please read the article given in the link. And he says, it is the exercise was useful distraction. It helped me focus on the data while compartmentalizing my emotions. This is very useful for us. Look at the data, see what has happened. And of course, I expect you to please read the article. So it says, in the worst of the horrific instances, including world wars, only a modest impact on corporate revenues and earnings were had. The business measures as to what drives over the long run matters. Over short periods of time, market data tends to overreact. So there's one line which I want to, on an average, the impact of these events is a 1 day loss of 1.1%. The total drawdown from the geopolitical event averages 4.8%, which means a 5% fall, which is not really much on a 60,000 index. It means a 3,000 point fall. That is the average. And it says it takes about 20 days to hit the bottom, and very importantly, it takes 43.2 days to recover. So if you just ignore the noise completely, like I said, don't worry too much about oil prices, don't use this short data to extrapolate over long data. We don't know what is going to happen. Accepting that we don't know what is going to happen is very useful. So please have a look at this link. Please have a look at this at the graph and the chart that he has made. So he says the result is an instructive chart. Most of the time, markets are hardly affected by these sort of terrible events. Even the US entry into World War II after the Pearl Harbor attack took just about a year to recover. And even the World War, it took only about 143 days to bottom out of which, and then 307 days to recover. The lesson is, I like his lesson where he says, never bet against human ingenuity, creativity or progress. In the face of horrific existential threats, while the headlines are terrible, gradual improvements constantly keep taking place below the surface. Even if you see the worst COVID deaths which were happening in the US, and even New York Times was saying the truth for a change, people were buying. The markets did not react so badly as people think it should. So when you see very bad and terrible headlines and you see the market going down, the best thing you can do, perhaps if you're very intelligent and know in which industry to enter, buy more of that. Don't jump in just because some share has fallen. For example, if cement has fallen, it may not be a good share to buy, or if coal and gas have gone up, again it may not be a great share to buy. But you should know which ones to buy, which ones to avoid. And coal and gas may even give you a 10-15% kind of a jump over the next few days, and coal may give you a 10-15% fall. Now if you are a clear value player, then you might go and buy cement, saying, okay, this is the reason, because of these uncertainty, I'm getting it at this price, so I will buy it. Or you may even buy coal and gas and wait and make 10% on that. So you could make 10% on the upside in one place, and you could have sold your cement and got 10%. So you could be bearish on one portion, bullish on another portion. I have seen one thing happening is metals are very strong for whatever reasons, but I have used it as an opportunity to sell some of my metal stocks. I've used so I have sold metal. I have not bought any oil marketing companies, but I have been bullish on ONGC, Oil India, HOEL, Hindustan Oil Exploration, Coal India and GAIL. I have been bullish on all this. I have bought. I have been bearish on cement for some time, right since the energy prices were up, and I have been vindicated that I think I may go and buy back. I may just do the reverse trade in a couple of days, that I sell off some of the energy stocks and perhaps buy metals if it corrects significantly. So some of these things you can do, or you can sit tight and and read the Rithol's article and not worry too much about what is going to happen, because the whole impact on your portfolio is not going to be more than 2 months at best. So after that, market will recover. But remember one thing, market is already at a high, and market can use this as an excuse to go down and stay there much longer. So beware of all this. So inaction is not so bad after all. Just sit tight. Thank you.